Look at this. Since launching Stock Advisor in 2002, our average recommendation has returned 1,007%. That's not cherry picked. Everything else is, but not this one. That's not cherry picked. That's across the board. During that same stretch, the S&P 500 returned just 173%. Okay. And they have the dates cited here. So that's super impressive. It really is. And I made a chart of this.
But what the gold return since that same date?
This is exactly what I did, Mike.
Oh, okay.
I couldn't believe it. So this is the
Excellent.
S&P 173. This is that 1,007%. You add in gold, 1,007%.
Hello, it's Mike Maloney and Alan Hibbard once again with the Gold Silver Show. Alan, how are you doing?
I am great, Mike. Thanks. How are you?
Absolutely wonderful today. There was a hurricane that went by recently, and we're still feeling the after effects of the rain and such. But you have a presentation that is going to be a complete surprise to me right now, and I just react as we go, right?
Oh, yes, exactly.
You haven't even told me what it's about yet.
Well, it's about people who hate gold. This is a video about the haters for the haters.
Okay.
So someone sent me
this should be fun.
Here. Yeah,
this should be fun. Yes.
Someone sent me this article here from the Motley Fool. Millions of Americans are falling into the gold trap. And I've seen many articles like this, people saying, don't buy gold, it's a terrible idea. And they cite all these different reasons. And the person who sent this to me was like, oh, what do you think about this? Maybe you could make a video about it. So that's what I'm doing. And to put it in perspective, they're saying, oh, Costco's selling over $200 million of gold every month. Forecasts are calling for $4,000 an ounce. But the last two times this happened, investors paid for it in years of lost growth. So we're going to go through this article. I'm going to go through all the parts of it, for the first half of it, and basically fact check the numbers and break down the logic and see if the logic is any good, or see if maybe they're omitting something or if they have something backwards or incorrect. So let's start here with the first thing they say. In 1980, gold hit what was then a historic high. Inflation was out of control. Oil prices were spiking. The Soviet Union had just invaded Afghanistan. Investors were gripped by fear, and gold felt like the only safe and steady place to be. For a moment, it looked like a brilliant move, the kind you mention at a barbecue to feel like the smartest guy holding a beer. Then in just 2 months, gold lost more than 40% of its value. Within a year, it was down nearly 65%, and it didn't recover that peak for another 27 years. So right off the bat, they're painting gold in a very ugly light. They're making it sound as bad as possible. So you want to jump in, Mike?
Well, they picked,
pick the high.
he should have actually said pick the date of the actual high, January 1980. He didn't put in January there. If you can do this with anything that goes through cycles. You pick the previous high, and then it takes years. I think we did in the book an inflation-adjusted S&P 500, and the crash of the NASDAQ. I mean, the NASDAQ took a long time, but even the S&P took more than 13 years to get back to its high. This is 27 years. And we are coming off of historic lows. Now, if you had bought in the first half of that bull market, when, if you bought, gold went up from 35 to 200 and then did a pullback to 103 from 70, the first day of 1975. For the next 14 or 16 months, it fell 16 months, I believe, to 103. So if you had bought in there, you would still look brilliant because you were in profit the whole time, even if you didn't buy at 35. If you bought at 150, at 180, at 190, you were brilliant, and you're still brilliant even with that. But the thing is, everything goes from overvalued to undervalued to overvalued to undervalued. And they picked what had been the most overvalued time in history to start this measurement. So the way this is phrased, it's true, but the intention is, Gold was $400 an ounce in November of 79. And by January, it was 850 at a close, 873 intraday. And so at that, it did go down to 250 by the year 2000. But yes, it was overvalued compared to the currency supply, compared to real estate, compared to the stock market. Gold was in a bubble, but they picked the peak of the bubble to start this measurement here. What's your comment?
Yeah, exactly. So if you pick the peak of any asset, it's going to go down moving forward by definition of what a peak is. So the issue I really have here is that they're sort of implying that today is like 1980, right? They're saying that like today is the peak of gold because so many other things in the world are the same. So let's actually look at these things. They're saying inflation was out of control. So let's look at inflation. They're saying oil prices were spiking. So let's look at oil prices. And the Soviet Union or Russia had just invaded Afghanistan or Ukraine. So let's look at that, okay? 3 things we're going to look at. And we're going to see if today is actually like 1980, starting with inflation. So you can see the CPI in blue. This was starting in 1967 all the way to 1982. The blue line, we see 3 waves here. In 1980, yes, inflation was out of control. It was high. It was 14%, 15% year over year. Absolutely. Where are we today? 2, 3%, not 14 or 15%. So I would argue that we have another massive wave of inflation coming if we're going to follow the parallel of the 1970s. And we're not there yet. We've got a few years probably until inflation is quote unquote out of control. So,
and here's another very interesting thing about this chart. The waves of inflation go along. There's a little bit of a lag time in the gold price. It was the first day of 1975 when gold did its turn. So through 74, it was rising, and then it did its turn and started falling in 75 into late 76. And then obviously it peaked in January of 1980. So this chart, if you take that blue inflation line and you shift it 6 months to a year, it tracks the gold price. That's very interesting. And yes, you are right. That red line. So this would be equivalent to buying, wow, where we are right now, if you shift it back 6 months, you're buying at the $103 low in 1976. That is where we are right now as far as if you want to compare these 2 bull markets. You're buying in the middle of, actually 2015 was the low in this cycle. We had a big dip back in 2015. But yeah, so anyway, very interesting. Okay.
Yeah. So I think their logic of, today is like 1980, inflation's out of control. I don't buy it. And these are the numbers that sort of disprove that. They also said oil prices were spiking. And if you look at the black line here, going back to 1950, 1960, 1970, and then all of a sudden, yes, it does spike going into 1980. And it more than doubled in just a year or 2, something like that. And the red line is what oil prices have been doing the last 30 years or so. They're all over the place. They're not exactly spiking. I would not say they're spiking. They're down roughly half from their peak, back in the 2008 financial crisis. So these 2 lines don't seem similar to me. I would not say that oil prices today look like they did in the 1970s. What do you think, Mike?
Yeah, and if you did a regression from like 2015, it looks like about 2014, there's that big fall there. If you did a regression from 1950 to 2014, and then another one from 2014 to today, you'd get one line that's going up and another line that's going down. And so you can see it's been falling since 2007, that big peak there. 2007, the big peak, the $140 peak.
Sorry, yeah. Mm-hmm.
Yeah, you can almost, so if you did a regressions, you would see this. It is very dissimilar to the 1980s.
Exactly. So inflation doesn't really look the same. Oil prices don't look the same. And the other one was Russia invading somebody. These are the days between the invasion and the peak of gold's price. So the Soviet Union invaded Afghanistan, I believe it was Christmas Eve of 1979. 28 days later, the price of gold peaked. All right. And then it went down for like 20 years. Russia invaded Ukraine. I think that was February of 2022. So we're 3.5 years in, and the price of gold hasn't peaked. It continues making all-time highs.
Right. So there's no correlation.
I don't see these as being related at all. I mean, 28 days later, that seems like relevant. But when you're talking 1,200 days later, it's like old news at that point.
Yeah. There's no correlation there at all.
Yeah. So the overall
that last
logic,
chart, I see a correlation that really supports our thesis, and it knocks the legs out from under whoever the article was written by.
Exactly.
Yeah. So, but this one, it's just zero correlation.
Yep. So they're off to they're what am I trying to say? They're off to bat. Is that the phrase?
Yeah, it's 0 for 3 at this point.
Oh, they're 0 for 3. They're 0 for 3. Yeah, but right off the bat, they're off the mark. I think that's what I was trying to. They're using terrible logic to start.
Yeah.
So then they say, and I'm not jumping ahead in the article. The next part of the article says, fast forward to 2011. So skip the next bull market in gold. Let's not talk about that. And then let's paint an ugly picture. The global economy was still shaky after the financial crisis. Debt levels were rising. Inflation was back in the headlines. Once again, gold took off. It broke a new record. And just like before, the floodgates opened. Investors rushed in thinking they were protecting themselves, but gold just stalled, of course, from the previous high. No crash, no growth, just dead weight for nearly 12 years. Meanwhile, the market went on to deliver the longest bull run in market history. That's the kind of quiet loss nobody talks about. So again, if you pick the next high, then by definition, things are going to go down immediately after. So This is another form of cherry picking. It's almost pointless. And then this is all just like narrative. They're not even like using numbers here. They're using your emotions. There's no substance to this.
Right. And you know, if we have, everybody's got 2020 hindsight, you know, you can see it perfectly clear that 2011 was the high, and that's when you should have sold. You should have bought right down in 1999, 2001 at that $250 double bottom. And you should have sold in 2011. And then you should have repurchased in 2015, at the end of 2015, beginning of 2016, and then you would be a genius.
Well, duh.
You know what? I'm very happy with my purchase. I started in 2003. I've been accumulating, and my silver. Silver is above all purchases that I've made are in profit over the past 20 years. I'm in profit. I don't have a single purchase that's underwater, and so I'm extremely happy. Now, if you compare this to the stock market, the stock market did the same things. And if you pick 1982 is when it was undervalued and you should have bought the stock market, and 2000 it was overvalued, and then it crashed and you should have bought in 2001, and then you should have sold in 2007, and then you should have bought again in 2012 or 13 whenever it bottomed. And no, actually it bottomed in March of 2009, and then after the global financial crisis, and that's when you should have bought, March of 2009. So anyway, this guy's cherry picking and using a bunch of vagaries to try and prove his point. So this is all emotion based.
Exactly. Okay. So, and we already looked at inflation, and we are going to come back to 2011 and the period that encapsulates 2011, because he's fast forwarding through that and getting to 2011. So we'll talk about that in a second.
Why didn't he pick the global financial crisis, 2008? Why didn't, you would think that if you were going to pick something, you don't pick the top, the peak of a gold market or a silver market. You would pick something in the economy. He just picked in Afghanistan was the previous thing versus Ukraine. And so if you pick the global financial crisis, fast forward to 2008 when you could have bought gold for $700. Changes this narrative completely, doesn't it?
Yeah, exactly. And also,
Okay.
he uses an interesting phrase here, the longest bull run in market history. So that's kind of weird because, who cares how long it is? You care about the magnitude. So if you could make
Right.
100x your money in a day, that's better than 1%, 1% for whatever. So this is weird. Longest bull market in history. And again, we're about to compare the bull run that he's talking about, that after 2011, we're about to compare the bull run in the market compared to the bull run in gold in just a second. So remember this, okay? And also remember the kind of quiet loss nobody talks about, because we're going to have another one of those in a second.
Okay.
So just real quick, I wanted to compare the two bull markets because he wanted to fast forward to 2011. So skip this gigantic run up. And he also didn't really credit gold for what it did in the 70s, ending in 1980, this 25x return while the stock market was flat. So no love for gold, no credit, not really giving a fair assessment here, just absolutely cherry picking two tops and then saying, well, after that, it went down. What a terrible idea. So not really a sincere analysis.
Cherry picking two tops and then saying after that it went down. If you pick the top, yes, it's going to go down.
That's what he's doing, right?
Yep.
So, okay,
exactly.
Let's see the great narrative that comes next. And now here we are again. Gold is making noise and millions of people are getting pulled in. But this time, you have the chance to make a more informed move, to think in patterns, not panic, and to invest in what's worked, not just what feels safe. Even doing nothing but putting your money into a simple S&P 500 index fund in 2011 would have left you far better off. We're going to look at that in just a second. That alone would have meant years of steady growth instead of a decade of dead weight. So,
you probably haven't done it in this presentation, but for anybody out there that subscribes to stock charts, there's a feature that they have called perf charts, performance charts. You can put in 2, 3, 4 different stocks or indexes or items like gold, and you can compare them over different periods of time. And yes, there are periods of time where the stocks outperform gold, but if you go to this century, just start it off on January 2nd, because January 1st is not a trading day, January 2nd, 2020, and you cover this entire century, gold has outperformed the S&P 500 by triple. More than triple. It's way, way ahead of it. It makes stocks look like a really stupid investment. Yeah, everything goes in its waves and cycles. But this article is doing nothing but cherry picking. Go ahead. I'm sorry I interrupted.
No, it's quite all right. So yeah, let's actually look at the next one here, because this is the last part of the article I'm going to read, and then I have the most hilarious plot twist after this. So it's so good. But what if there was something that not only outperformed gold, but also outperformed the market and outperformed it consistently for more than 2 decades? That's what I want to show you today. So this is the product that they're selling. They have a stock picking service that you can pay money for. Okay.
So this whole article is written as basically it's sort of a dishonest advertisement for whatever they're selling. They're trying to scare you into their subscription. Okay.
Yes.
Sorry.
And look at this. Since launching Stock Advisor in 2002, our average recommendation has returned 1,007%. That's not cherry picked. Everything else is, but not this one. That's not cherry picked. That's across the board. During that same stretch, the S&P 500 returned just 173%. Okay. And they have the dates cited here. So that's super impressive. It really is. And I made a chart of this.
But what the gold return since that same date?
This is exactly what I did, Mike.
Oh, okay.
I couldn't believe it. So this is the S&P 173. This is that 1,007%. You add in gold, 1,007%.
Awesome.
This is the actual numbers from February 8th, 2002 to June 23rd, 2025. That was the date the article was written. I mean, this is hilarious. So even all their bragging, they can beat the market, they can't beat gold.
Right.
They can't beat gold. I mean, this is just hilarious.
And they're trying to scare you into gold by making it look like gold doesn't perform.
They're trying to scare you out of gold and into their
out of gold,
and into their volatile stocks, right? Some of them are going to lose a ton of money. Oh my goodness, this is just so dishonest.
Right, and they're writing a newsletter, and if you don't take the action at the exact same time that they do, you're not going to have the performance that they were able to achieve. But they achieved this, which is admirable. They did a great job, but they did that with things that are highly volatile. And here you have something with zero counterparty risk. You can hold it in your hand. These are all stock picks. So you're investing in a company that has a management team and has a whole bunch of other vulnerabilities that they can actually go broke. They can go to zero, and gold cannot go to zero. That's like, I suppose it could if humans became extinct. It would go to zero, right?
Exactly. No, stocks would go to zero too.
Gold, huh?
But stocks would go to zero too.
Yes, right. And so would his 1,007% gains on the portfolio. That would go to zero as well. So
yeah.
Okay.
So this is absolutely hilarious. And I just want to revisit one of the sentences they said before. That's the kind of quiet loss nobody talks about. So there's another kind of quiet loss here. If you read their newsletter every month, and if you read up on all the companies and you spend a lot of time and energy trying to get behind their investing thesis for all these different companies, you spend time making the trades, you log into your brokerage account, when the one brokerage account is acquired by another brokerage account, you got to create a new account, a new password. All this time you spend reading up on the news, watching the ticker symbols, studying all this stuff. That's the kind of quiet loss that nobody talks about, is spending all that time monitoring those investments that may or may not pay off. And even with their fantastic performance, it wasn't as good as gold. And this is over 23 years. 23 years. Right. So that's the kind of quiet loss that I think everyone should be thinking about. Do you want to spend all that time watching all those companies? Maybe not.
Yeah, every once in a while we get somebody in the comments saying that I'm just trying to sell gold and silver. Well, while it's a great protection for people, yes, I do want to do that. But we're not skewing. And we make a lot of what I consider very high quality information available for free. And it's not a cheap thing to do this. The number of people that we employ at goldsilver.com to provide all of this information. And we are doing it on, it's a marketing strategy. There was an old movie called Pay It Forward about doing something good and just saying, pay it forward, do something good for somebody else. We try and do something for people first. Hopefully they trust us and come to us to buy because we've just been giving them high quality information for years.
Yeah. So I agree completely. Completely. And part of my philosophy doing this is that I'm not trying to make money off of people. What I want to do is I want people to think about how they want to spend their time and how they want to live their life. And I am a huge believer that if you own gold, silver, and Bitcoin, you can then have all your time back available to you. You get the full 24 hours in the day back. Whereas if you're invested in stocks, bonds, real estate, whatever, a lot of your time every day is sucked into those investments. And that's fine if that's what you want to do. But I think a lot of people go into that on autopilot and they don't realize how much time they're draining on those things, and they don't have to. So that's actually something I talk about in an upcoming video here, saving versus investing. So if you hold stocks, bonds, real estate, or all that other stuff, you're investing. That requires an ongoing stream of your time and attention. Whereas if you're saving, you can just hold gold, silver, Bitcoin, and you can set it and forget it. You don't have to think about it. You don't have to watch the news. You don't have to read earnings reports, none of that. So this is
I find exactly what you're talking about. I really love gold is simple. You buy it and you sit on it. And then there will come a day where it's overvalued and it is in a bubble and you want to sell it and acquire other assets. But the other assets are a lot more work. I'm actually not looking forward to that as much. I don't like getting when my brokerage, right now, I don't have anything that's being traded on my brokerage platform. I took delivery of my stock certificates. I've got a bunch of private placements in silver and in precious metals, mining and explorers. But I don't like all of the junk mail. I consider it all junk mail that I get from them, all the votes that they have to have and everything else that just fills up your mailbox. And with gold, you just go and check the price once in a while. And usually you are pleased.
That's right. That's right. Awesome. Well, the last thing I'm going to say here is that the name of this series is Hidden Secrets of Value. It is, of course, an homage to your series, Mike, Hidden Secrets of Money. And so this is a 6-parter that's going to be coming out this fall. So if anyone wants to see it, it's my philosophy on value. A lot of great content in there. It's going to be coming out very soon.
Awesome. Congratulations. I've seen a preview of this, and it looks like it's a great series. So congratulations on that, Alan.
Well, thank you so much, Mike. It's a pleasure to be working alongside of you and carrying forward the torch. So thank you very much.
Okay. And I want to thank everybody for watching. And Alan, I'll see you later.
Yep. See you, Mike. Thanks, everyone. Invest and earn up to $2,000 in bonus silver at goldsilver.com. It's easy. Step 1. Open any gold silver storage account excluding IRAs. Step 2. Purchase your precious metals. Step 3. Get up to $2,000 in bonus silver dropped straight into your vault. Visit goldsilver.com/free silver to claim your silver.